Welcome to The Explainer. Today we're really looking beneath the surface of digital assets to decode the actual mechanics of global crypto markets. If you've ever stared at a financial ticker and wondered, wait, who or what is actually deciding those rapidly changing numbers? Well, you're definitely in the right place.
Let's just start with a really foundational question. Does Bitcoin have one official price? Is there some central authority or a single global system sitting somewhere, controlling the market and declaring its value for the day? The answer to that is a definitive no.
Yeah, the idea of one centralized official price is completely a myth. It's not like the traditional markets you might be used to. Crypto trading doesn't happen in a single, tightly controlled room. Instead, it works through this vast, globally connected exchange ecosystem. There is absolutely no single entity sitting at a desk declaring what Bitcoin or really any other digital asset is worth today.
So here's our roadmap for today. First, the myth of one price. Second, how prices emerge. Third, exchange types. Fourth, why prices differ. Fifth, how arbitrage aligns markets. And finally, the new financial infrastructure.
All right, let's jump straight into part one, the myth of one price and uncovering the global ecosystem.
So rather than one centralized room, crypto operates through these globally connected liquidity networks. We are talking about hundreds of platforms worldwide, spanning North America, Europe, Asia, literally everywhere in between. And keep in mind, these markets run 24 hours a day, 7 days a week. There is no closing bell here. They rely entirely on deep liquidity and millions of active participants around the clock.
Moving on to part two, how crypto prices emerge. Let's look at the base mechanics. The actual engine driving this entire ecosystem is the live order book. Every single crypto exchange out there operates through one. You can think of it as a real-time digital auction house. On one side, you have buyers placing bids, basically what they're willing to pay. And on the flip side, sellers are placing offers, what they're willing to accept.
So prices aren't declared, they emerge. The market price that you see on your screen, that's simply the very last price where a buyer and a seller actually agreed. The exact moment a buy order matches a sell order, a trade happens, and boom, the market moves. It is pure, continuous market demand meeting supply in real time.
Which brings us to part three, understanding crypto exchange types, specifically CEX versus DEX.
Now, the two main categories here are centralized exchanges, we call them CEX for short, and decentralized exchanges, or DEX. A centralized exchange is basically a company-operated platform. It's managed by a corporate entity, it requires identity verification, standard KYC stuff, and it handles fiat on and off ramps. That just means they're the ones converting your traditional dollars or euros into crypto. A decentralized exchange, on the other hand, operates entirely on the blockchain itself. It's non-custodial, meaning you hold your own digital keys. And the trading? Well, that's managed completely by automated smart contracts rather than a corporate entity.
To give you some tangible examples, on the centralized side, you have these massive global platforms, right? Places like Binance, Coinbase, and Kraken, alongside regional leaders like CoinDCX. Then, on the decentralized side, open and global access is provided by blockchain protocols. Think Uniswap or PancakeSwap. Together, these two parallel systems form the real backbone of global crypto trading.
Let's move on to part four, why global prices differ and what causes the discrepancy. Because these exchanges operate completely independently all over the world, you get this really fascinating dynamic where the exact same asset can trade at slightly different prices. Like at this exact second, Bitcoin might be $67,240 on Binance, but slightly higher at $67,255 on Coinbase, while reflecting entirely different local values over in Europe or India. It's the exact same asset for sure, but these different markets end up yielding slightly different localized pricing.
So why does this happen? Well, it really comes down to market friction. Exchanges just have different depths of available capital, what we call liquidity. They also face unique, localized demand and supply behaviors. And then on top of that, you throw in currency conversions, local tax laws, and platform fees. All of these factors combined create these small but persistent price gaps right across the ecosystem.
All right, part five, arbitrage, the great aligner.
Arbitrage is essentially the invisible, systematic force that prevents these localized prices from just completely drifting apart. It's a highly rational process, and it usually plays out in three logical steps. Step one, a trader identifies a price gap and buys the asset cheaper on one exchange. Step two, they transfer or maybe hedge that asset. And step three, They sell it for a higher price on another exchange.
Whenever a price gap widens, arbitrage instantly takes over. Today, you have millions of traders, large institutions, and automated algorithms constantly exploiting these tiny differences, literally in milliseconds. And the mechanics are simple. Buying on the cheaper exchange naturally pushes that local price up, while selling on the more expensive one pushes its price down. The end result? Global markets are organically forced right back into equilibrium, all without a central bank ever needing to intervene.
This leads us to our final section, Part 6, the new global financial infrastructure, bridging local to global.
We can actually use India as a perfect case study for how all this connects. India is a massive participant in the global crypto ecosystem. So local exchanges there, like CoinDCX, CoinSwitch, and ZebPay, they basically serve as vital connection points. They plug domestic users directly into the deep global liquidity of major hubs. But they have to do this while operating within strict local financial conditions. That means navigating INR currency liquidity, handling specific local taxation rules like TDS, and managing domestic banking compliance.
When you step back and put all of these pieces together, you realize you aren't just looking at a digital asset. You're looking at a remarkably sophisticated system. You've got hundreds of exchanges, deep liquidity for millions of global participants, and the continuous balancing act of arbitrage operating 24/7. It's a borderless, permissionless, and completely transparent financial market built entirely on code.
Which leaves us with this one crucial takeaway. Crypto prices are not controlled. They emerge from a globally connected 24/7 market shaped by exchanges, liquidity, arbitrage, and global participation. What we're witnessing is an entirely new kind of global financial infrastructure.
So now that you have a better structural understanding of how these markets actually function beneath the surface, we'd love to hear from you. What part of crypto or blockchain infrastructure should we simplify next?